Hello and welcome to Accounting Instruction Help and How To. In this lecture we're going to talk about the audit reports. So we've actually completed the audit. At the end of the audit we're going to make the audit reports expressing the opinion. These reports will of course be standardized. So we'll take a look at those. We will be able to describe components of the standard unqualified report, explain when added explanatory language is needed. We want to discuss when to depart from the standard unqualified report, and describe materiality on the auditor's decisions of the type of audit report. And then we're going to explain auditor's responsibility for reporting on specific accounts or items. So we're going to start off, of course, with the standard unqualified audit report. Now that name might sound a little bit strange. We have an audit report. Remember what we're trying to do here. We're trying to take the financial statements from the company and give an opinion as to whether they are in conformity with GAAP, generally accepted accounting principles. So you'd think the best audit report would say something like, yes, these are in conformity, and have kind of a positive sounding word related to that. But no, the best report that we have is called an unqualified report. So why is the report saying that the financial statements are correct called unqualified report? It's basically saying that we don't have any qualifications. So there's nothing that we're going to say in here that says the financial statements are correctly reported in accordance with GAAP, except for this qualification. We don't have any qualifications, therefore it's an unqualified report. So you just got to kind of grasp that, remember that. The best report that we're going to start off with, the base report that we'll actually read through, is going to be the unqualified report. And then if there's any problems, any qualifications, we will talk about how to deal with those. The report that we will report will be based on the evidence that we have gathered, if it's a publicly traded company, in accordance with the Public Company Accounting Oversight Board, the PCAOB, and that the financial statements, of course, are in conformity with GAAP, generally accepted accounting principles. So we're actually going to read through the standard unqualified report, and it's going to be a bit tedious. I don't like to read through the whole thing, but it's going to be the standard report that everything else is based on. So it really is worth the time to go through, read through the actual report, look at the components of that report. That's what all reports will be based on, and then look at the alterations that would then happen if there's some kind of changes that we need to make going forward. So the components of the report, we're going to usually have the title of the report. We're going to address it. It's going to be addressed to someone. Oftentimes the stockholders are who we're going to address it to. And then we're going to have the introductory paragraph, a scope paragraph, an opinion paragraph, an explanatory paragraph, and then we'll have the name and the date of the report will be the conclusion of the report. It's going to be in a similar format that we format many different types of reports. We're going to have an introductory saying what we are talking about, what we're going to talk about, and what we had done here. Then we're going to have the scope paragraph explaining in more detail about the scope of what we are doing. And then the opinion is kind of like the conclusion of this. We're going to give the opinion on what we have done based on how we have done it. And then the explanatory paragraph is kind of another paragraph that's tagged on there, because that's going to deal with the internal controls. We're also going to say, hey, we also looked at the internal controls through this process and give some reporting in terms of the internal controls of what we have found in that area as well. So the introductory paragraph, we're going to start off with the introduction. Here it is. And like I said, the wording will be fairly standardized in the unqualified report. We're going to be looking at an unqualified report for basically a publicly traded company. A non-publicly traded company will have a slightly different report, but the gist of it will be much the same. So we have audited the consolidated balance sheet of the company as of the year-end date. Let's say it's 12/31, and then the year, and the related consolidated statement of operations, stockholders' equity, cash flows for each of the year or periods ended for whatever year or period were ended 12/31 and the year. So it's saying what we have actually done. We're actually explaining that this is what we have done in the introduction. These financial statements are the responsibility of the company's management. Our responsibility is to express an opinion on these financial statements based on our audits. So we're saying what the responsibilities are and making it clear that our responsibility is to have an opinion, not to actually create the financial statements. The financial statements creation are the responsibility of management. Then we're going to move on to the scope, giving some more context on what this involves. What does our opinion involve? How does that process work? So here's the scope paragraph. We conducted our audits in accordance with the standards of public Company Accounting Oversight Board. Those standards require that we plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatements. An audit includes examining on a test basis evidence supporting the amounts and disclosures in the financial statements. An audit also includes assessing the accounting principles used and significant estimates made by management, as well as evaluating the overall financial statement presentation. We believe that our audit provides a reasonable basis for our opinion. So what does an audit include? How do we do the audit? We give some more information on the scope, what the audit process entails. And then we're going to give our opinion, kind of like the conclusion. We said, hey, this is what we're going to do. We're going to give an opinion. Here's how we did it. And here's going to be the conclusion, the opinion. So the opinion paragraph, then we'll read something like, in our opinion, the consolidated financial statements referred to above present fairly in all material respects. The financial position of the company as of, let's say, 12/31, and then the year, and the results of its operations, its cash flows for that period year ended. So we're saying the period, which of course is the balance sheet as of a period of time, and then we have the time frame, which of course is the income statement, and then it's in conformity with U.S. generally accepted accounting principles. So we're given the opinion. If it's unqualified, we give the opinion. Note the terminology there that we are saying that it's free, is presented fairly in all material respects. So we are putting that hedge in there in all material respects. That idea of materiality, of course, being a big concept. Then we have this explanatory paragraph, which is another paragraph which relates to the internal controls. Because remember, publicly traded companies, we have to audit internal controls, and we're giving the opinion on the internal controls. So we have also audited in accordance with the standards of the Public Company Accounting Oversight Board, the effectiveness of the company's internal controls over financial reporting as of the year end, December in the year, based on criteria established in internal control integrated framework issued by the Committee of Sponsoring Organizations of the Tweedway Commission, and our reported date, February, and whatever the date is, express an unqualified opinion about the company's maintained in all material respects effective internal controls. So we're given an unqualified opinion in this case on the internal controls as well, meaning there's no qualifications that we're going to cite here in terms of the internal controls. So basically they look good in relation to the audit that we have. Then we've got our name, then we've got the date. That's going to be the standard report. Again, terminology being for the publicly traded company. In this example, if we have a non-publicly traded company, terminology is slightly different, but much the same in terms of the content of the report. There could be conditions when we have adjustments to the unqualified report, meaning we have the unqualified report, but we might add some explanatory language, like an explanatory paragraph. For example, if we believe that the company would not be a going concern, that is the terminology for the idea that the company is going to maintain itself throughout time. And that's going to be the usual assertion we have. When we think about a company, we think that they're in business to stay in business. And if we believe that there's an impairment to that, either through the choice of the company or through some external conditions, which means that they will not be a going concern, that is something that we should note in an explanatory paragraph. We may also have a condition where we're not able to audit a particular part of the company, or that part of the company was audited by another firm. For example, if a part of the company was on the other side of the country and it was audited by another accounting firm, or if we had a subsidiary of the company in some way that was significant to the audit process and it was audited by another company, then we would have to note that and let it be known that this part of the audit is not our responsibility. It has been audited, but it's been audited by another firm. We can also have a problem with a lack of consistency. So if there's some conditions that could cause a lack of consistency, such as a change in accounting principle, a change in a reporting entity, or something like a correction of a misstatement, those are things that could cause some consistency problems from comparisons of one period to the next period. We then have conditions or circumstances that may require us to abandon the entire unqualified opinion altogether, meaning we couldn't give the best opinion of the unqualified opinion, and we'd have to give some other opinion, perhaps a qualified opinion. So a qualified opinion would basically say, hey, there's a qualification here. It's not unqualified. We have a problem that we need to qualify. And these are going to be things we could have scope limitations. We could have a departure from GAAP. And of course, that's what we're auditing. We're trying to see if the financial statements are in accordance with GAAP. So if there's a departure, that could be a problem. If there's a lack of independence, then that would require us to not give the opinion as an unqualified opinion, of course, as well. The types of reports that we could give if we're not going with the standard unqualified opinion, if there are a significant problem, obviously we could say, well, there's a qualification. It's okay except for this qualification. Now, if there's severe differences, we could have a disclaimer, meaning that basically means we couldn't complete the report. That usually is a result from a scope limitation. We couldn't get to the information we needed to in order to do the proper testing, either through management, the company not letting us do that, or through some other circumstance, which means that we just couldn't get to the information we needed to, and therefore we're not basically having a disclaimer. We're not going to give the opinion or an adverse opinion. Now, adverse opinion, of course, means that we're giving an opinion as to whether the financial statements are materially correct, reported in accordance with generally accepted accounting principles. If they are not, then we'd have to give the adverse opinion. So if we think through this type of hierarchy, if we have the unqualified opinion, that's when we don't really have a problem. If we've got some kind of issues within the unqualified opinion, then we'd have an unqualified opinion with wording or explanatory paragraph. And those are the things like, let's say there was another auditor involved, or let's say there was that going concern problem, a lack of consistency issue, additional emphasis. If we think those are something that we need to put into the report but are not material to the point of issuing a qualified opinion, then we can have the unqualified opinion and the unqualified opinion with the explanatory paragraph. If there then is a scope limitation or a GAAP limitation, and that becomes material, if we have a material scope limitation and GAAP limitation, then the scope limitation, if it's client imposed or whether it's some outside condition, and that means that we couldn't get to some information that we felt we needed to audit that could be materially significant, then of course we could give a qualified opinion and saying there's a scope limitation. We can say, hey, it's in accordance with generally accepted accounting principles, except for this qualification, this scope limitation, which is material. And if it's very material, then we couldn't do the work we needed to do in order to give an opinion at all in that condition. We'd have to say it's a disclaimer. We're going to say we couldn't do it, we couldn't get to it, therefore we'll disclaim the opinion. We can't really give an opinion. If we're going to a GAAP problem, remember that the GAAP, we're saying, GAAP is what we're trying to give an opinion on. We're trying to say the financial statements in accordance with GAAP. If there's a material piece of the financial statements that are not in accordance with GAAP, then we could give a qualified opinion saying the financial statements are in accordance with GAAP basically, except for with this qualification of this piece, and give that piece. Or if there's a significant departure and it's very material, then of course we'd have to say, well, we are auditing this in order to give an opinion as to whether the financial statements are in accordance with GAAP. If they are not, then we'd give that adverse opinion.